Welcome back to the Paper Gain Show. I'm Jonathan Rankin, one of your hosts. I'm joined by my co-host, Matt McGee. Matt, how are you doing these days?
I'm doing great. Glad to be here. Looking forward to jumping into a little tariff and volatility conversation.
Yeah, I mean the markets are performing just as well as my March Madness bracket, which is in dead last place in our pool. So, yeah, it's not been a fun couple days. And in fact, just for those who are listening, we're recording this at the market close on April 7th. So, as of right now, the S&P is down just about 14% for the year. The Nasdaq is down 19, and the Dow is down just about 11. But from their highs set in February, S&P is down 17, Nasdaq's down 22, and the Dow's down about 15 and a half. And we did see the S&P hit correction territory or bear market territory today, down 20%, but it recovered from there. But it's been a wild couple days. So I'm excited to talk about what's going on, how did we get here, and what do we expect from here? Because I know you're facing a lot of questions from clients, and I've been talking to a lot as well. So what have for the listeners, how do you feel like we got to this point of so much volatility when I think everybody knew tariffs were going to be on the docket?
Yeah, I would say how we got here would be a very long conversation, but economically to this point, that just from to more directly answer your question in this format would be I think everybody knew tariffs were out there. They had started to be thrown around and slapped on various countries. But then there was Liberation Day last Thursday, or I guess that was Wednesday at market close. And then everything happened on Thursday. But I think that that's the classic expectations versus reality. I mean, people like tariffs, call it 100 or 200 billion, are one thing, but trying to get tariff revenue to the U.S. to a trillion plus is something very different. And they just, my observation from listening to podcasts with people much smarter than myself, they just exceeded what the market believed, and it took everybody by surprise. Was my observation, and
The way
then
they came up with these tariffs,
activity.
the way they came up with
Yeah,
these tariffs was just, it was so, it was like out of an SNL skit, I feel like.
yeah, it
So,
really was not in a good way.
no, no, it
Uh,
wasn't. But we're here, and this is where when we think about is this something that do you feel like this is a negotiating tactic, like something? So I feel like there's like a couple different camps. There's the camp of this is a negotiating tactic. This isn't going to last forever, and then there are some that are no, this is these are here to stay because these are going to be revenue generating. So what camp are you in?
I go back and forth. This whole thing is really uh, mind blowing, and is real a real interesting mental exercise, if you will, for a lot of people, just because you find people justifying it, but it's just a very complicated issue, as you well know. Uh, but where I find myself leaning is I think tariffs are here to stay to a degree. I think if you can rebalance things from a trade perspective that puts us on even footing, or at least where we're not getting taken advantage of, um, I think is a positive. Uh, do I think iPhones need to be or will get made in America, or a microwave, or all the stuff that we spent 30, 40 years moving to Mexico, India, uh, China. Um, do I think that's going to happen? No, I think one, it takes years to build all of those factories. Two, like who's going to do it? Are you just going to rely solely on robots? just so many unknown questions. And I think that's what the market, as we both know, hates, and that's uncertainty. And that's really what we've had the past
Yeah.
5 days.
Well, and when you think about, it's funny because I listened to Peter Navarro, who's, the head of trade and things like that with President Trump. And really it seems like there was also two factions within inside of the White House. You've got Elon,
Yeah.
who says, hey, 0% tariffs across the board. If we all agree on that, then we're good. And then you've got Peter Navarro, who said this morning, even if countries come with 0% tariffs, that's not good enough. We want, they're still getting over on us on currency manipulation, all this other stuff. And the whole goal is we've got to bring manufacturing back here, which it's going to take, like you said, it's going to take years to do that. But also, what Gen Z person right now do you know that's going to be willing and wanting to just sit in a factory making screws for an iPhone or belt loops or just any random thing that we've moved manufacturing over? I don't know many that are. So,
Yeah.
we used to be a manufacturing society where 40% of what we did was manufactured here, but now it's what, 12 to 13%. And, we're a service society. We're a consumer and we're a service society. So I don't know. It's interesting to see, these different camps, even within the White House. And I look at it as, this is all done by executive order. So, Congress hasn't come into play yet, but Congress are people too, congressmen and women, outside of the Pelosi's of the world that, people talk about with, their own portfolios. But if you're a new congressperson who hasn't been in for a long time, and all of a sudden you have a say because you're an elected official, and you have to go home every night, sit at the dinner table with your husband or wife and your kids and go, yeah, honey, we're down, 20%. And they're people too. And so at some point it's going to turn into a, inside of the whole, inside of the government, there's got to be some conversation at some point, but I think it's going to go a lot longer than we expect.
Yeah, I think to go into that a little further, if Trump wants to do the Tax Cuts and Jobs Act, extend the tax policy that he did in his first term that expires at the end of this year, that he's trying to put into law permanently, he needs every vote he can get. And so I have to imagine thank God for checks and balances in situations like this, because if he needs every vote, all of these congressmen and women have to be absolutely getting hammered with phone calls from concerned business owners, just in general, just the uncertainty that we've had the last 5 days. Not to mention, just think of a lot of the billionaires that helped fund his re-election. I mean, you look at Amazon and Jeff Bezos. I don't know the exact percentage of Amazon goods that come from China, but I have to imagine it's a meaningful percentage. So, he's somebody that can at least get a meeting, I imagine, with Trump. So, there's so many interesting dynamics at play here. But I agree with you. The Gen Zer, I don't imagine building that iPhone, nor I imagine interested in paying another $300 to $500 and pushing that iPhone cost to $2,000, for a new iPhone. They're already expensive, and that's so. We'll see.
So what are you, as you've had conversations with clients over the past couple of days, what are you telling clients?
Yeah. So one comes to mind of somebody that reached out today that really just wanted to reassure this individual that, hey, we've prepared for this. We de-risked things in her particular situation a month ago, just as volatility spiked. So really positioned the portfolio to weather the storm, and hopefully this passes soon, and then you're positioned to take advantage of the upside and get those losses back and move on down the road to the next situation that comes up. So managing cash is foundational in situations like this. And so just making sure this individual has enough cash, if not, get them that cash so that, or set it aside, and just make sure that they feel comfortable to weather the storm and let the portfolio do what it's meant to do, and that is compound over a long period of time.
Very
What
good
about
point.
you?
So, I've had a number of these conversations, and I've had the luxury, if you would call that, or the misfortune, whichever you want to call it. You can flip a coin to determine which, if it's good or bad. But I went through 07, 08, 09, that time frame, and all of the different corrections and mini corrections and sell-offs since then, and doing that, working with clients. And this one, what fascinates me with this correction that we've seen is that this was all like discussed, and this was something where they came out, and Trump and Elon, they were very transparent. And we talked about this, I think, on episode 1, where they said there's going to be pain. This is not going to be easy. Trump, he's said it for a while, and so it's listening to what's been said before. Granted, are the magnitude of tariffs, are they higher and bigger than what we expected? Yeah, they are. Are they some formula that nobody understands how or why they came to that formula? Yeah. Is it a little ridiculous? Yes, but they've been transparent with the fact that it's going to be painful to get there, 100%. And so,
Yes.
We use that as a de-risking opportunity a while ago, but now it's really about, we're not going to be able to time where this thing ends, because today is a perfect example. If you watch the market today, there was a period in the morning where there was a headline that came out that said they're going to delay the tariffs by 90 days, and the market rallied by like 8% in 25 minutes.
It was wild.
And what this reminds me of, it really reminds me of the post 2009 to around 2014, 2015 timeframe, where a lot of the market, obviously there were earnings there as well, but a lot of the market was based on quantitative easing. And so you had one person at that time, it was the Fed chair, and everything hinged on that decision of, are they going to continue quantitative easing, or are they going to slow it down and stop it? That's why we saw so many. If you go back, type in taper tantrum into whatever chat GPT tool you use, and it's going to explain to you exactly what I mean. So when you have an economy, or not, I wouldn't say an economy, but a market that's dictated on one person with a microphone that gets to determine the way that we go, and they can play a video game with it, and they can say, well, I can have a headline and that's going to shoot the market up, and now it's going to shoot it down. You can't time that. So for clients that we've de-risked beforehand, the conversation now is, okay, at what point do we start adding risk? And knowing that we're going to do it in a way that's going to be thoughtful and disciplined, and it's not all going to be at one time, because there's no way we're going to be able to time this thing. I personally, we've talked about before, I think we're headed for a recession. I think that Trump's wanted a recession. That's what he wants this whole time, because they want to be able to bring rates down, and the Fed's not acting fast enough. Just look at what he said today. There's a tweet that he put out that said just to that effect, that let me find this here. This is what he said just a little while ago, about earlier today. He said, oil prices are down, interest rates are down. The slow-moving Fed should cut rates. So they want rates lower. And so if the Fed's not going to do it faster or as fast as he wants, well, guess what? He's just going to throw us into a recession, knowing that he's going to force our hand at some point to lower rates to get us out of this thing. That's my opinion. So I look at this as, the market's not priced for a recession right now. I think every analyst will tell you, if it's priced for a recession, we've got to reduce the multiple, and we've got to reduce the earnings per share, which is going to put us, at a further drawdown. But we can't time that. So it's setting up, whether it's 4 weeks, 8 weeks, 10 weeks, 12 weeks, whatever that frequency and cadence is, just establishing a dollar cost averaging cadence to take advantage of the fact that if you did de-risk, now is a good time to start adding risk. But I look at this as, this was to be expected, And unfortunately, this is where we're at. And yeah, is it frustrating? Nobody likes a bear market. I can tell you right now, these aren't fun, but this is the reason why you get paid to invest. Yeah, if you're an investor, you get paid by years, like 2023, where we've had a tremendous growth year. Unfortunately, the market's almost wiped out 2024, so I won't we won't count that one yet. But
Yeah.
That's really what I've been telling clients is that, look, now's not the time to de-risk. The de-risking time was already in the past. It's either about, hey, we hold steady and we manage cash flow and we manage, we make sure that we're able to have reserves that we can pull from if we need to wait till things recover, or we slowly start adding risk. Those are really, to me, the only two options that we want to focus on right now.
Yeah, a couple things. I did hear, I guess, to the first comment of how that tweet came out earlier today about the 90-day pause that they said was fake news. Yeah, it is mind-blowing to see an anonymous Twitter account move markets like truly like trillions of dollars. Like it went from -4% to +2%, like you said, in 25 minutes. And I guess on the social media and just media in general, like for those that are the most concerned, like unplugging and just getting away from the constant news cycle, I have found to be very helpful, because looking at Twitter all weekend was it gets very negative and starts to impact you if you just are constantly refreshing, which is easy to do in markets like this. But to your point about the Fed, I did hear, I don't think they're about to cut rates just yet, but I did see like the percentage, which these have been wildly wrong in the past, of the percentage estimated that they expect to cut at a future meeting. I saw it was like 98% expect to cut at the June meeting, and that they had a emergency conference today. So who knows what any of that means? Probably just getting on the same page given everything that's been unfolding, but definitely not expecting a rate cut yet.
Well, it's funny because when you look at anything, there is so much noise. There's noise that's going to tell you, hey, this market could go down another 25, 30%. It can get really nasty. And there's all these correlations to the Great Depression and how we haven't seen times like this since then. And then I just came across this piece right here. Let me share this with you. Where's that at? So just saw this. This is the S&P 500 biggest 3-day percentage declines, and the forward returns going back to 1950. And if you look, the 1 year, 3 year, 5 year returns, they're all positive. So if you look at that, you go, well, it's all, this is what history's told us. Now, I guarantee you, this is just something that I came across just on the cuff. I'll bet you that we can go down the rabbit hole and find, contradicting information that says, well, based on some sort of statistic, this is what happens. It kind of reminds me of like right before the Super Bowl when they say, well, this elephant has picked has predicted the winner of the Super Bowl 9 out of the last 10 times. And that would be like trying to, put all of your money on whoever's going to win that based on some elephant. So, there's statistics, and then, you have to take them for kind of what they are. And this one was interesting. Does this mean I'm going to go all in right now? No, I think having a disciplined approach is definitely going to help. That's just my opinion.
Yeah, I agree. And it's always good to see, which makes complete sense. Like after you have large drawdowns, like future returns should be higher. And we, just as a reminder, just because we all have very short-term memories and attention spans, we're coming off of like 2 years that are back-to-back 20 plus years. So a little perspective there.
which is rare in itself.
Yeah, exactly. So is this necessary? Probably so. Is it enjoyable? No. Did it, even though it was expected to a degree, nobody expected it. I think tariffs at this level, which maybe it is a negotiating tactic. I would love to see uh, some victories, some trade deals soon. I think everybody would. I know especially from the big countries like India and China, hopefully being the biggest one. But yeah, so we'll see. But I like your approach of getting ready to deploy new cash where appropriate and layering on risk thoughtfully over the coming months.
Yeah, well, and using this time as well strategically for things like tax loss harvesting. I know it's only the beginning of the year, or kind of early part of the year, but using that if you've got gains in other areas to start harvesting some of those, and then Roth conversions. I know we kind of talked about that as
Yeah.
using this time to start thinking about that. But I don't want to forget you. I know you had something you wanted to share, which was the let me put that up here. Come on.
Yeah.
Yeah, do you want to kind of talk through this chart here?
Yeah, so this effectively tells the same story as the other chart that you just showed for the S&P 500 after major geopolitical events. Uh, Really, I guess, hitting on uh, like Brexit, COVID was that was roughly a 2 month period, February through really the 23rd of March of 2020, that we had that very rapid 30+% decline in the subsequent returns after. And so, and then the war in Ukraine, that was coupled with, as a reminder for everybody, in 2022, inflation had gotten to 8-9% in the United States. And so the Fed raised rates 5%. And so that really hurt bonds as well as equities. And that was really that slow stairwell down, if you will.
Now, do you
So,
do you consider this a geopolitical event? Now, obviously, there's politics involved with it. Would you consider this a geopolitical event?
yeah, yeah. I mean, it's a
I'm just
event.
curious. Like I said,
Really,
I don't.
uh, it's a little different than like 9/11 or any of the. A lot of those are war related, but this is not economic warfare, but it's between countries. So yeah, I would consider this in the geopolitical bucket, if you will, as we try to renegotiate some of these trade deals that in many cases have been around for decades, probably.
So, well, before we get out here, what do you want to leave anybody who's listening to this with your biggest takeaway, your biggest piece of advice when it comes to navigating, these the markets, volatility, you name it.
Yeah, I would say closing remarks would be, if you don't have a good plan in place and you're feeling overwhelmed and not sure where to begin, uh, now's a great time to start having conversations with advisors to see what that can look like for you in your specific situation. If you don't like the plan that you have in place, that's also a good time to reconsider things. But I know we said this in previous episodes, this too shall pass, but we'll see when that is. But I'm still long-term optimistic that um, the administration knows what it's doing, is helping put us in a better long-term position. I think Jamie Dimon was the one that came out and said, like, America first is one thing. America by itself is something totally different, and I'm hopeful that's not where we're headed. I don't think that's what we need as a country. I think we still need all of these trade partners. I think just getting on a level footing where we're not getting taken advantage of through all the stuff that we've talked about. So that's what I'm hopeful for. And so I think just staying the course and executing whatever plan is appropriate, depending on your situation. Now's the time to lean on that and find comfort and tune out the noise if it starts to feel overwhelming. What about you?
So my biggest takeaways are, one, we don't know what the bottom is going to be, and we're only going to know what that bottom is when we look back. And at the time when we look back on it, it's going to seem like an obvious bottom, but to try to time that is going to be next to impossible. And I think today was a perfect example of that. There was a period where the S&P rallied 5.6% in 8 minutes, and then it lost 4.3% in the next 7 minutes. So in a 15-minute time span, it had this massive swing. So we're never going to be able to time the bottom. So selling everything always sounds like a good in theory. I want to get on the sidelines because this could get a lot worse, and then I'm going to buy back in when it gets better. Well, the reality is when it gets better is usually when it's higher, and buying high and selling low is just not a good recipe for making money. And then I always let people know it's okay to not know what's going to happen. It's okay to be uncertain. It's okay to be worried about what's going to happen, because especially in times like this where we don't have historical data points to say, well, here's how the economy typically reacted under something like this, because this is a little different. This is a trade war that, I don't think many expected this magnitude. And if it does actually go through, we don't know how deep this can get. But, just knowing that this is why you diversify. This is why you have an asset allocation to help mitigate risk so that you can withstand times like this. And then, I just think it's very important to know what kind of investor you are. Everybody forgets about risk in the good times, and they're always quickly reminded in times like this. So use this time just to assess yourself, your financial goals, your financial life, and just remember that the time to de-risk was a couple weeks ago. Right now it's either you're going to kind of hold on and have we're going to wait till things get back, or you're going to have a process to start adding to any sort of investment strategy that you've got to take advantage of this volatility. But just try to make sound decisions, because I've seen so many people make massive changes to their portfolio that they'll end up regretting 1, 3, 5, 10 years down the road when they look back and go, if I just didn't do that because whatever it was faster than I realized, or I should have got back in, and I didn't. But making big changes during these times is usually not the best thing to do. So that's what I would put people with. And hopefully this was helpful. We'll probably do a lot more of this tariff talk as things progress. And I appreciate everybody listening.
Yeah, I guess one closing remark. I think Morgan Housel said it recently. Volatility is like the fee that we all pay for long-term returns. So that felt very relevant. It was a lot calmer when I originally heard that, and you're like, yeah, that makes sense. But then you get 2 days like Thursday and Friday, you're like, yeah, all right, that makes a lot of sense. But hopefully some calmer days ahead. I'll see you soon.
All right. See you guys soon.